24 seconds away from the opening bell this morning. Good morning to you. Negative by 0.5% on the S&P 500. On the Nasdaq, down by a similar amount. No real drama here going into the opening bell as we close out the month of May and a stellar month of gains for the big cap names in big tech. There's your opening bell. Switch at the board and get to the bond market. Yields look like this on a 10-year, down a single basis point, 367.32. More Fed speak from Loretta Mester in the Financial Times, signaling she wants to hike again in the month of June. Others will follow. Let's see what the Fed speak looks like going into the quiet period, which kicks off on Saturday. Bit of dollar strength out there, euro weakness. That euro weakness pronounced, much more so following that economic data out of China. Disappointing. The euro 106.86. Haven't seen 108 for about a week. Euro dollar negative by 0.5%, and crude breaking lower. We're talking about multi-year lows now, potentially, on WTI in the 60s, 68 on WTI, down about 0.8% this morning. One stock to watch at the open, HP, shares under pressure after reporting lower than expected 2Q revenue. The CEO saying this: the macro situation is obviously impacting demand across industries. However, we think the second half will be stronger than the first. Abby has more. Hey, Abby.
Hey, John. It's interesting because analysts seem to agree with the CEO of HP that the second half demand will recover. But in terms of the second quarter, it was disappointing. Sales came in light of what was expected. They declined 22% to $12.9 billion. The personal system segment fell 29% to $8.2 billion. That was short of the average analyst estimate of $8.4 billion. On the year, John, we do have analysts, though, echoing, again, what the CEO said, that the second half could see some sort of return to normalcy for PC demand. Morgan Stanley saying that this is the bottom. Lots of mixed messages here. On the year, this stock up about 15% right now, having its worst day since it actually might be a little bit more. I can kind of look while we're on air here, but when I last looked, the worst day since February of this year, and I think it's going to be a greater decline, which suggests that traders are weighing these results despite the fact that there could be some kind of recovery. Yes, we're looking at the worst day since August of last year, that traders are really weighing these results and not paying as much attention to the possibility of that second half recovery. We'll have to stay tuned.
Down 6%, Abby. The hope things get better. That's always the hope. Right now on the S&P 500, negative by 0.3%. Nasdaq just a touch lighter. We're down there by 0.2%. Want to stick with earnings. Shares of Advanced Auto Parts getting hammered after missing on Q1 estimates, cutting its full-year guidance and reducing its quarterly dividend. The CEO writing, quote, "We expect the competitive dynamics we faced in the first quarter to continue, resulting in a shortfall to our 2023 expectations." Katie Greifeld has more. Hey, Katie.
Hey, John. Well, as analysts from Truist phrased it, everything that could go wrong, whatever could go wrong, did go wrong when it comes to this report. Nearly every metric was disappointing, John. Like you said, the auto parts retailer cut its earnings and sales guidance for the full year. It did reduce that quarterly dividend from $1.50 to just 25 cents. And that's all after, of course, it missed estimates for the first quarter. Like you said, CEO Tom Greco saying that the competitive dynamics that we saw in the first quarter will continue to hound Advanced Auto for the year to come. To get a little bit more specific, the company now sees full year EPS between $6 to $6.50. The previous forecast was between $10.20 to $11.20. So a big cut there. And as you would expect, the market reaction has been swift and it's been brutal. Right now, shares are off by almost 29%. As such, right now, that is the worst day ever for Advanced Auto.
Wow. Katie, thank you. A third of the market cap gone. Just like that. Let's stick with the auto sector. Tesla's Elon Musk meeting more government officials on the second day of his trip to China. Wedbush's Dan Ives saying the visit comes at a key time, writing this: playing nice in the sandbox in Beijing is something the street is laser focused on to make sure there's no disruptions to Tesla's expansion. David Welch of Bloomberg joins us right now. David, are we playing nice?
Really, Elon has to play nice in China. He's got an expansion going on, big plant in Shanghai, and he sells a lot of cars there. I think if you look at it, really, Mary Barra at General Motors has to do the same thing. So do the German car makers. They all have a big presence there. They have joint venture partners. And if you really want to grow your electric vehicle business and you want to get global scale for battery, electric motors, all that expensive stuff, you need to be able to participate in China. And the domestic players there are coming on strong, and BYD now being the #1 seller of electric vehicles in the world. So if politics cuts Tesla General Motors, German car makers out of that market in any way, or even just diminishes their ability to sell vehicles there, that's a big problem for all of them in terms of global competition.
And David, this stock's had quite a year, up 61%. What's behind the monster gains this year relative to the difficulties we had in the previous year?
I think investors are getting used to the idea that Tesla's been cutting its prices. There seems to be a bit of stability there. I think they see Tesla having an ability to use their margin advantage to really hold off competition from the other car companies. I think last year, one of the things that hurt the shares was the fact that we had new EVs coming on from Hyundai, Kia, General Motors, Ford, and if Tesla can use a pricing advantage to still make decent profits while maintaining market share or even growing it, investors are going to like that.
David, the stock is a little bit lower this morning, down by 1%, but much, much higher on the year. David Welch there, thank you. From Tesla to Twitter, you might have seen this story yesterday that according to Fidelity, Twitter is now worth just 1/3 of the $44 billion that Elon Musk paid for the social media platform. But I think what a lot of people missed is this. Despite those issues, and because of the gains in Tesla, Elon Musk's wealth is up more than $48 billion this year. So never mind the $44 billion he paid for it last year. His wealth this year is up something like $50 billion US dollars. Tesla is up 61% year to date, and down about 1% on the session. Let's go from that to the financials. Goldman considering another wave of layoffs in what would be its third round of cuts in under a year. A representative for Goldman declined to comment. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, when this news first crossed yesterday, we didn't see too much of a share price reaction. It ended the day lower by just a few tenths of 1%, but the losses are steeper this morning with the stock now down about 1 3/4%. So one of the laggards in the financial index on this Wednesday. Now, as you said, this would be the third round of cuts in less than a year. Of course, they eliminated several hundred jobs back in September of 2022. Then in January began their biggest round of layoffs ever, eliminating 3,200 positions. And now another round, we understand, according to people familiar, though it should be smaller, affecting less than 250 people, but they are expected to be more senior members of the firm. Of course, all of this happening as Goldman and banks across Wall Street are contending with a slump in deal making. That recovery has been very hard to find. It is a slump that likely will continue throughout the remainder of this year, and it has led to a reevaluation of costs. Goldman, if you recall, back in February said it does plan to reduce expenses by $1 billion, and potentially now more layoffs are going to be part of that story. Again, John, the stock down about 1.7% here in the first few minutes of trading.
Kelly, thank you. About 7 minutes into this session, more broadly on the S&P 500, we pulled back just a touch, down by 0.5%. Some relative outperformance in the Nasdaq, but still lower by 0.3%. Stocks closing in on another monthly advance thanks to the rally in big tech. The S&P 500 eyeing a third month of gains despite only 28% of the index trading higher this month. That's the worst breadth for a monthly gain on records going back to 1990. Morgan Stanley's Andrew Sliman weighing in on those bad breath concerns.
There's no conclusive proof that actually bad breath doesn't lead to always a sell-off. Many times it leads to broadening breadth in the market rally. I think that will happen. I'm just not sure, other than short term on a debt deal, I'm not sure that will happen until we get past Labor Day.
And joining us now is Bank of America's Jill Carey-Hall. Jill, wonderful to catch up with you. It's a conversation I've had with your colleague Savita, others too. I'd love your input on this subject too. Does narrow breadth matter?
Thanks for having me. You know, we've found similar to what was just mentioned in that, you know, narrow breadth and bad breadth in the market doesn't necessarily mean, you know, negative returns. You know, the better market returns have often followed periods of bad breath. So we haven't necessarily seen that as a signal. That said, you know, the market has been led by a lot of these big mega cap tech or growth stocks. And, you know, we have a relatively benign outlook on the S&P 500 for the remainder of the year. We did get incrementally more bullish. We raised our target recently to 4,300 from 4,000. But, you know, we're more bullish on some of the areas like energy and what we'd call the old economy cyclicals rather than some of the newer growth areas. You know, we saw a sort of surprise bout of QE in the first part of the year, and that's an environment when growth stocks usually do well. But we expect expect more quantitative tightening rather than quantitative easing going forward. And we're equal weight tech. We would prefer tech to communication services. I think a lot of the AI spending and broader CapEx spending will benefit tech more, and it's a less crowded area. But there's still risks to tech as a cyclical sector, and you saw a lot of demand pull forward. So we're market weight the tech sector and would see leadership from some of the other cyclical areas.
Jill, let's deal with the index. As you know, year to date and month to date, we've seen massive outperformance for things like the NASDAQ versus the equal weight. The equal weight S&P 500 this month, and we've talked about this repeatedly this morning, is down by 3%. The NASDAQ is flying by more than 8%. That's 11 points of outperformance. This is kind of like historic stuff here, Jill. And if you don't have the muscle of big tech in the portfolio right now, the AI themes that you touched on, you're really not having a great year. Jill, why is this the time? And just to go back to your research, why is this the time to prefer the equal weighted S&P 500 to the cap weighted index?
Well, I think the equal weighted index is, much more attractively valued at this point, given the divergence that we've seen. A lot of the cap weighted index is much more expensive. It's, more crowded in some of those areas. So, better value. And we do think, as I mentioned, that, some of the new leadership in the market could be areas like energy, like parts of materials. We could see a resilient CapEx cycle, this year, even amidst a recession. So I think, these are areas that could be the new leadership. The market has been hit by, obviously everything going on with credit and the regional banks. Small caps have underperformed. The equal weighted index has underperformed given the rally in tech that we've seen. But at this point, we would prefer the equal weighted over the cap weighted index.
You head up the strategy for small caps as well over at BofA, Jill, so perhaps we can finish there. You turned cautious back in March, I remember, off the back of some of the financial difficulties. Given the weightings towards financials in the Russell, makes perfect sense. Jill, where are you in the team now on that particular topic?
Yeah, we've still been tactically cautious on small caps. We've obviously been watching the credit backdrop and the regional banking backdrop. The small caps do obviously have more exposure to regional banks as well as to credit conditions. We have seen further tightening, obviously nothing too detrimental. Our credit stress indicators that our firm tracks are still elevated, but we're not critical. So we're watching all of these. I also think, ahead of the debt ceilings, as we've seen market volatility, small caps tend to be more negatively sensitive to volatile markets. So, near term we have stayed cautious, but I think if we can see, a stabilization in continued stabilization in banks and credit, and we just get this sort of mild economic recession that our economists are looking for, then, I do think small caps are pricing in the mild economic recession more adequately. And, if you have a longer time horizon, this could be a good entry point for small caps. We've still been bullish over the long term on small caps, relative valuations versus larger near decade lows. And, they're going to benefit from a lot of the multi-year themes like globalization peaking, reshoring. They're bigger beneficiaries of CapEx spending. They're more domestic. So I do think for a longer time horizon, we would see better return potential there.
Hey, Jill, always appreciate your input. Jill Carey-Hill there of Bank of America. They lifted their price target recently over at BofA to 4,300, incremental, as Jill said herself. Marginal upside there on the index, on the S&P 500. The enthusiasm over at BofA on the equal weight S&P, stripping out the muscle of some of the big gainers this year, which have been the likes of Nvidia and Meta, but that's where the gains have been. Is that where the gains will be in the second half of this year as well? About 13 minutes into the session, we pulled back by 0.3% on the S&P. On the NASDAQ, we're almost unchanged on the session. Coming up, the Fed in focus as more U.S. economic data hits the wires.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
It's the final two-week stretch going into the Fed's June 14th rate decision.
my simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
Sometimes economic data is so bad, it's good for treasuries. Yield to lower at the front end by 7 basis points on a 2-year. Mike McKee has the why. Hey, Mike.
Well, John, it's the Chicago PMI, which comes in very, very weak at 40.4, down from 48.6. The forecast was for just a small change. So that is considered bad news, but it is a tertiary indicator, and we have had some discrepancies among the regional PMIs. The real question is what happens on a national basis. And because of the calendar, we got a very compressed week. Almost everything happening tomorrow and Friday. JOLTS comes out today, top of the hour. You'll want to stay tuned for that. That could have an impact on the market if job openings stay high. But then ISM tomorrow, we have a forecast for a very small change, but that could go down after we saw what happened with Chicago. And we'll want to see what happens in the employment index as far as ISM, but also ADP tomorrow and initial claims tomorrow. They're all supposed to show some changes in the markets, but initial claims, we don't know the way it's been going. We do have, because of the shortened week, not much time for people to change their forecasts for payrolls, but Friday, John, we're expecting 195. We've been over the expectation for something like 8 months now, and unemployment rate 3.5%. That would only be a tick up, and it would probably turn the conversation and the markets back to higher rates.
And Mike McKee, 3.5% unemployment does not scream recession. The data in services right now does not scream recession. But then you've got manufacturing, Mike. What is happening with manufacturing versus everything else?
Well, that's an interesting question, because usually if manufacturing is slumping, it's because people don't want to buy stuff. And maybe it's partly because they don't want to buy stuff because they're spending all their money on services. But it's a little hard to square the two things. And we won't get the ISM services number until next week, unfortunately. So we won't have that as an ingredient into jobs. But jobs and then CPI, those are going to be the big numbers that will set the Fed's course.
June 2nd, Friday, payrolls. June 13th, CPI. Mike, thank you, sir. From the data to the Fed speak, a host of Fed officials on the calendar throughout today, going into the quiet period this weekend, getting their final word in before that begins, and ahead of that June 14th rate decision. Ed Harrison joins us now. Ed, let's talk about it. Mester's talking about another hike maybe in June. Just how splintered is this committee becoming?
Yeah, I think we're at the maximum point of splintering, because you hear people like Chicago Fed President Austin Goolsbee, who wants to pause immediately. And then you hear others like Jim Bullard from St. Louis, who are saying, look, we can continue going. Even Mester herself said that she would probably go for a hike. I think that how he's able to get everyone on side. And I think the easiest way to get everyone on side at this particular juncture is to potentially pause as soon as possible, maybe as soon as June, and then to hold for a longer period of time. And they look like they're moving the market in that direction.
What kind of data points do you think we need to see between now and then for that to happen? Andrew Hollenhorst, the City, Ed, I think set the bar pretty low. He said 200K payrolls, 0.4% on core CPI month on month, and he said they're going to go again in June. How low or how high do you think the bar is right now?
Yeah, I think that the biggest thing probably is the labor market, as you were pointing out, payrolls. We're going to get to JOLTS data. That's going to tell us, whether or not the demand for labor is coming down. And then we're going to get as well the payrolls data. If it's over 200K, let's say 250, I think that's a really high number. We're already at about 60% chance of a 25 basis point rate hike on markets. I think you'd start to get closer to 80% at that juncture, and then the Fed would go ahead and probably hike again in June.
And maybe we'll get some dissent along the way for once. Ed, great to catch up with you, buddy. Let's catch up before we get that Fed decision. 2 weeks today, looking ahead to JOLTS. Ed talked about it, Mike talked about it. Alex Steele is going to break that down for you on Bloomberg TV in about 8 minutes' time. Your estimates at the moment, the previous number close to 9.6 million, looking forward to that to come down to about 9.4 based on our estimates. That's the median estimate in our survey so far, so looking for that to come from 9.6 down to 9.4. You'll get the actual figure in about 7 or 8 minutes. Let's get you some sector price action. We can do that now with Abby.
We're looking at pretty bearish sector composition, John. Most sectors are lower, and we in fact have 4 sectors that are down. At the same time, we have 3 sectors that are up slightly: tech, real estate, utilities. To the downside, though, we're being led by energy, financials, materials, and industrials. Let's take a closer look at energy because we, of course, as you've been talking about, have oil below $70 a barrel. Those China PPIs not so great, and actually that Chicago information not great either. But near year-to-date lows, down 13% on the year, John. Right now headed to its worst year since the pandemic year. Let's see whether or not those are recouped or if oil and copper are sending signals about the economy.
Abby, thank you. Right now down by 0.4% on the broader S&P 500. Saw this market turn off the back of that Chicago PMI data, more specifically in a more pronounced way into the bond market at the very front of the yield curve on a 2-year. Now down by 7 basis points, just pulling back and retracing some of that move higher we've seen over the previous 11, 12 days. Last week, the week before that, the 2-year up big time. Month to date before today, the 2-year was up something like 44 basis points. So just chipping away at that as we go into June. We're down another 7 to about 437. Up next, your trading diary.
Day, like Bloomberg.
26 minutes in, stocks lower. Let's get to the trading diary. Coming up very, very shortly in about 5 minutes' time, we'll get you some economic data at the top of the hour. We'll get you the JOLTS report. Fed speak picks up this afternoon with Collins, Harker and Jefferson. ISM manufacturing numbers and another round of claims coming up on Thursday. Plus earnings from Macy's. That's still to come. And on Friday, it's the main event, the May payrolls report. Looking back and looking for a number that could come in close to about 200k. The estimate so far, about 195. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, May 31st. Here are the top market stories that we're following for you at this hour. Investing with bad breath. Just a handful of stocks keep pushing tech higher. S&P trades around 4,200. We look at the divide between investors with FOMO and those scared of weak breath. And Lazard's new chief, we're going to sit down for an interview with Peter Orszag, who takes the CEO seat as Lazard is dealing with a deal-making slump. And the job jolt. The debt deal clears committee heads to the House, so the markets now look to jobs for the next catalyst. We're going to get the jolts breaking right now. From New York, I'm Alex Steele with Tom McKenzie in London. Guy Johnson is off today. Welcome to Bloomberg Markets. I'm interested to see about the jolts because we got that the Chicago PMI came in weak, and we did see a stronger bid into the front end of the bond market.
It's a bigger number than expected. Let's get the analysis straight away now with Bloomberg's Mike McKee. Mike, standing by with the data. We look ahead to non-farms, of course, on Friday, but for now, it's jolts. Wow.
It is jolts, and this is going to have an impact on the markets, probably a bigger one than we saw from the Chicago PMI because it goes up significantly to 10,103,000. We're back above 10 million. The prior month, March, was revised to 9,745,000. So a few more job openings in March and certainly a lot more job openings in the month of April. The quits rate, which people kind of take as a proxy for how strong the economy is, does tick down to 2.4% from 2.5%. So there is some good news there. But overall, this is not going to be seen as good news at the Fed. On the last business day of April is when they say this takes place. That was a rise of 358,000. In terms of hires, little change, 6.1 million, and the hiring rate at 3.9%. So at this point, the Fed's still confronting the kind of tight labor market it has been complaining about all along, and they've been using jolts as sort of an anchor for that. The more job openings there are, the harder it is to attract people, and the more companies have to pay up, which contributes to the possible inflation situation that we've got. So not good news this morning from jolts.
No, the good news is the bad news kind of situation, Mike. Appreciate you breaking it down. Bloomberg's Michael McKee. Equity is still trading a little bit heavy, but you are seeing the bid into the bond market in the front end a bit less. So now you have yields down by about 3 basis points. Before the number, they were down by about 8 basis points. So let's get to the question of the day then, because I think it all ties in as we look at positioning headed into that jobs number. How much should you care about bad breath? A lot of conversation has been made about how only a few stocks are leading the NASDAQ 100 higher. And is that a bad sign, a good sign, or something you need to ignore or look through? Joining us now, Bloomberg's Kriti Gupta and Isabel Lee. Okay, Kriti, do we worry about bad breath? You first.
No, and here's why. Traditionally, I would say yes, and the reason is, I'll give you the case for that first, is you need kind of this idea of a rising tide lifts all boats, and that means that we're in an expansionary phase for the economy, so breadth really matters. The exception is this time, and this is the one time I would say this because it kind of goes against every fiber of my being, but this is not the first time that you're starting to see tech-heavy leadership. You saw it in 2020, you saw it in 2021, you even saw it pre-COVID for an entire decade, and it's okay for it to be tech-heavy leadership because at the end of the day, that's where the investment is coming from. The economic growth is coming from the tech sector predominantly, even in a decelerating growth environment. And for that reason, you do start to see that there is going to be a lot of kind of not just current investment, but further investment both fiscally and from funds itself. And I think the criticism of this is that when you see this kind of tech leadership, you start to see 25, 35% weightings in the S&P 500. And ordinarily, that's a scary number. But look around the world. We have cases for this. In the Kospi index in South Korea, for example, one name makes up 33% of the index at Samsung. Same story in Canada. Same story in a lot of the emerging markets. This isn't as crazy of a phenomenon as I think a lot of people think it is.
And Chrissy, just to add to that context then, our terminal on our charts wizard Dan Curtis giving us the data earlier in terms of the context. Going back to the 1990s, so record in terms of the monthly gains being lifted by such a small number of stocks, the fewest stocks in terms of supporting this monthly rally on record. Going back to 1990, just 28% of the index is higher this month. Isabel, bringing you in at this point, does the narrowness, does it start to bleed out into other sectors then? Is that where the bull case lies around this narrow rally?
So the narrow rally, many people are criticizing it, but then to Kriti's point, it's really not that bad. History has shown that usually an S&P's gain or NASDAQ gain is really just from a handful of stocks. We have BMO crunching down the data 11 times out of the 12 times that they analyzed, in which there was a stellar period of the top five stocks rallying. The S&P gained 6.7% in the 6-month period. Now, many may say this narrow breadth isn't really the epitome or the sign of a new bull market, but one can argue that this breadth can really broaden. It's not like it's only May, we're still 6 months here on out, so it's really not that big of a sign. So for them, narrow breadth isn't that bad. It's really just how everything happens.
Tom, what's so interesting though is that we heard the large speculators positioning is still the most bearish now since 2007 for the NASDAQ 100. So again, it's the whole like, I feel really bad about this rally. I am kind of worried about it, but someone obviously is still buying and not worried about the breadth.
That uncomfortable rally. Well, Citi putting out a note earlier this morning as well, saying, look, the strategists there saying there is positioning now for profit taking within that run-up that we've seen in tech. It's looking overdone, is the call from Citi. And Kriti, bringing you back in here, we've also touched on the fact that there seems to have been a breakdown between the narrative that higher yields are bad for technology. Does that continue, do you think?
It does definitely continue, and the reason is because that breakdown has been in the works for, I want to say, about 2 years now, specifically because one of the big things that was affecting it was in 2020 and arguably the front half of 2021, when you saw a lot of these tech companies borrow at very, very low premiums. Essentially, the credit markets were saying, we're going to gobble up this issuance because at the end of the day, we think tech is almost, keyword almost, as safe as U.S. debt, and that's why you saw those extremely low premiums, and as a result, these tech companies sitting on piles and piles of cash that they weren't able to really deploy in traditional acquisitions because of the regulatory environment. Now, if you were sitting on piles and piles of cash and interest rates go up, that cash in theory is going to be worth less, and that's really where you saw the yields and tech kind of inverse correlation show up. But to your point, and to both of your points about the idea of this breadth story, I think one of the concerns here isn't in the index itself, it's in the way that a lot of these ETFs are formed actually. A great piece in the FT talking about the fact that as you start to see the indexes themselves get bigger and have these bigger allocations to a Microsoft and Nvidia, a tech sector, whatever that may be, the underlying ETFs then have to kind of rearrange themselves, and that lag ends up creating a bigger issue from a fundamental investing point of view in terms of liquidity, in terms of kind of the plumbing as opposed to the actual index itself.
I don't know. I feel like when we start talking about all the gamma hedging and we talk about the ETF structure, I feel like we're kind of like grasping at straws to explain a rally, to be honest. But Isabel, sorry, you want to say something?
No, I was just going to agree with some parts that Kriti said. The reason why this rally looks kind of extreme is because they're just all tech stocks. And this is really a tech story at the end of the day because of the Nvidia craze and even the banking turmoil. When that started to collapse in March, a lot of people, investors, flocked into tech stocks because that to them was a safe haven because these tech stocks would generate good cash flow, they had good balance sheets. So it's really a tech story, and history shows that only a handful of stocks lift benchmark rallies, but then for now it's just so happened that it's all tech stocks. But back then it was more diversified. You had Coke, you had IBM, Intel, Cisco. But now it's just all tech stocks. The big 7 or big 8, depends on who you ask, or the big 5.
Right.
So I think that's really why people are just scratching their heads, perhaps.
So, Tom, it also makes me scratch my head, too, and bringing the debt ceiling, is that the idea that maybe tech is a safety trade on the debt ceiling fears. And so I'm also wondering if we do get a debt ceiling resolution, does that change the calculus?
Right, does that lead to slightly more risk appetite if indeed that is the trade, if that is the safe haven trade? Do you push out and do you increase your diversification? Because there's no diversification at this point in terms of portfolios if you're heavily exposed to that run-up in tech, Kriti. Surely that is a concern as well for money managers.
It is and it isn't, because at the end of the day, when you're talking about diversification, if you really need to diversify, it's pretty easy, not to bring an ETF back into it, but hop into the S&P, the SPY ETF, and you'll get that diversification. But
I think the real concern is to find where the growth actually is. Remember, in a decelerating growth environment from an economic point of view, growth has always performed well. You can go see all the way back into the 50s and the 60s when the likes of Texas Instruments, IBM, Disney, Walmart, those were your big growth players. So I think it really speaks to the idea that this is kind of old patterns dying hard a little bit, and this time, when you're talking about the AI frenzy and you're talking about whether or not this is a 1999-esque bubble, we'll really follow where the money is going, because both from a fiscal and now a technological point of view, there is real money going into this market.
Hence, then brings up the FOMO part. Like, you don't want to miss that, and that sort of exacerbates everything. Thank you so much. Really appreciate a great setup for today. Bloomberg's Kriti Gupta and Isabel Lee, thank you very much. So coming up, I'll get more on our insight into the question of the day. Should you care about bad breath? How do you deal with bad breath? Amy Silverman of RBC Capital Markets will be joining us. This is Bloomberg.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
That was JP Morgan Chairman and CEO Jamie Dimon in an exclusive interview with Bloomberg TV earlier. So let's get to the question of the day, and we're going to talk about the debt ceiling a little bit too, is how much should you care about bad breath? And this is all made for the NASDAQ 100, the powerful rally being led by only a handful of stocks. Everyone keeps freaking out about it, and yet you still have money coming in. Joining us now, Amy Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Amy, should I care about bad breath?
I think you should, Alex. And look, from an options context, the reason is because this bad breath or this narrow breath, it really messes with volatility. It messes with how you look at correlation in the markets, and thereby it messes with what options seem to tell you. It seems to tell you that things are resilient when the reality is there can be very violent rotations under the surface that is masked because of the narrowness of breadth in the market right now.
Amy, there's a case, isn't there, though, that this is money that's being locked up for a point where investors have that increased risk appetite and they start to put that to play more broadly across these markets. The money markets, we know, are flush with cash as well, so that's another potential catalyst. What are the areas, what could be the trigger for that change, and why is that maybe questionable as a proposition?
Yeah, it's an interesting question. I would say one of the potential triggers, which to be fair, we have already seen, is FOMO. And when you think about FOMO, just, the momentum begetting momentum, it really exacerbates itself on the option side. So look, NVIDIA obviously had blowout earnings, that I don't want to take anything away from that. But what was exacerbated on top of that was the demand for call option buying. That, this is the same exact phenomenon that we saw in GameStop, that we saw in AMC, that we saw in Salesforce. And what happens is options is a mechanism to magnify FOMO. And when that happens, you can get such outsized moves that it also forces other people who are under allocated to pay attention.
So Amy, where else are you noticing that kind of action right now? Or was it just like an NVIDIA thing, or is it a broad NASDAQ 100 thing, or is there other stocks you're watching with that dynamic?
Yeah, it's funny, Alex, because, we actually had thought for most of this year that phenomenon had kind of gone away, as the risk-free rate got higher, there's this real alternative. And so what has really surprised me is time and time again, the equity market can get stuck to a narrative that they really like, and that FOMO still returns. And we saw that with NVIDIA, but we also saw that with AMD. We also saw that with Meta. We see it with AI beneficiary stocks where, the equity market latches on to a theme it really likes. And you, in particular, see it in these mega cap tech names over and over again, especially in the last 5 years.
Amy, to be clear, do you think the run-up that we've seen, at least in the last few days, from NVIDIA is divorced from fundamentals?
Yeah. So again, not to take away anything from its blowout earnings, but part of it was this imbalance that we saw between call demand and put demand. So we refer to that as skew inversion. But, to translate that, what you're just saying is the demand for calls was so high that it was actually greater than demand for puts. That's unusual in the options market. The options market is typically a market that people use to hedge their stock returns. And so when you get into this cycle, I'll have to throw out the word gamma. I know people don't like it, but, that gamma dynamic where you have the dealer who has to hedge on the other side of being short calls. What do? They buy stock. That begets positive momentum. When people see that momentum, they feel like they have to pile in. Look, this is a short-lived phenomenon. It creates local highs, but it is very real. It's the same thing you saw in August of 2021 with Salesforce.
So, and the other question I wind up having, Tom, we talked about this a little bit in the last segment too, is that if you have a debt ceiling resolution, the whole liquidity drain, right? You're going to have money going into T-bills because Treasury is going to be issuing, where that money comes from, and does liquidity get drained, and sort of then what the trickle down effect of that is going to be, Tom?
So that is literally the trillion-dollar question, isn't it? We'll be getting analysis, of course, from Andrew Sheets later in the show around how that's going to ripple through the credit markets, the money markets, and particularly which sections of the equity markets are vulnerable. Amy, let's bring you in on that question around tighter liquidity on the back of a deal that is inked by the president, if we get that by that deadline, the ex-date of June the 5th. What do you see in terms of the equity markets as the vulnerability to that tightened liquidity?
Yeah, that's a very interesting question. And, I'll bring it even more 10,000-foot view up, which is just in general, the switch from quantitative easing to quantitative tightening is, potentially going to cause a regime shift in volatility. We haven't seen it for so long that I think we're a little bit on training wheels in terms of what that means for vols. I will tell you what the market is pricing right now, though, is a little bit more relief, because if you just think about in terms of the headline, we do have a debt ceiling resolution. We're not going to map a VIX back to 2011 where it spiked around 48 and kind of held steady around 30. We're much further below that. And so what's happening real time is most folks are actually rolling off some hedges they had on. That's kind of bringing in volatility levels to be softer, but that doesn't speak to what I think would be a longer-term concern when you see liquidity being pulled out of the market in force.
Hey, Amy, before we let you go, what's your trade into Jobs Friday? What would you be doing?
Yeah, look, I think what's interesting is given the narrow breadth in the market, and two, given data points that are coming up, I think there's a question to be had of, have we gone too far too fast? And as vols come in, just very simple, shorter dated hedges could be interesting, especially as some of the hedges have rolled off, have created an opportunity at lower volatility levels.
Okay, looking for those short-term hedges as the tech rally looks to be running out of steam. The view there from Amy Wu-Silverman of RBC Capital Markets with a warning on FOMO back in these markets. Still ahead, US and EU officials meeting in Sweden to discuss AI regulation. That's as US officials appear split over the best path forward. The details next in the startup. This is Bloomberg.
It's great questions.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Simone Foxman. U.S. mortgage rates surged to the highest level since early November last week, when debt ceiling talks were still at an impasse, stifling demand for home purchases and refinancings. The contract rate on a 30-year fixed mortgage increased 22 basis points to 6.91%. That's according to Mortgage Bankers Association data today. The European Central Bank is hitting the final stretch of its interest rate hiking. European Central Bank Vice President Luis de Guindos spoke to Bloomberg.
The news that we have received from several countries are very good, are very positive. They go in the right direction. Headline is declining. I think that we have run a very important part of the journey, and we are entering into the final stretch.
The ECB also released its financial stability report today. And Biden administration officials are divided over how aggressively new artificial intelligence tools should be regulated. Some White House and Commerce Department officials support the strong measures proposed by the European Union for AI products. Meanwhile, U.S. national security officials and some in the State Department say aggressive regulation will put the U.S. at a competitive disadvantage to China. And that's your Business Flash. Alex.
All right, thanks so much, Simone. Appreciate it. All right, it is 23 minutes past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Caroline Hyde. Let's stick with that AI story being discussed in Sweden. Is the EU and the U.S. aligned? Like, where are we here?
Well, we have splits within the U.S. administration itself, as we were just hearing from Simone. And then, yes, there is this gathering impetus that the EU is just going to be, A, a step ahead of the curve when it comes to actually enacting regulation. regulation because unlikely to get much done within Congress, but also the ways in which you regulate. So the AI Act looks as though initially it was going to be how do we apply AI technology, whether it's in infrastructure, whether it's in more high-risk areas. I mean, we already see Palantir thinking about how you apply AI to making war decisions. But now there's a growing consensus that actually, no, you have to go to the underlying technology itself. You have to regulate the companies. You have to regulate the way in which data is being sucked in to the learning and whether there's biases within them, whether or not there's copyright issues within it all. So EU seems to be taking a more aggressive path now with the AI Act. And within the US, that's bringing some consternation because we've got, as we heard, the State Department worrying about competition with China if you regulate too hard. And then the other side, some within the administration thinking, yes, you do need to regulate, and pretty significantly.
Yeah, Caroline, that debate is live, isn't it? You don't need reminding. Madame Vestager, the commissioner who kind of leads up the policy change and adjustments out of the EU, she's very proud of the fact that they're setting the framework on this. And they've been active on the policy front around tech, obviously, over the last few years, but also slapping companies with fines. What is the kind of US corporate response to this more proactive approach from the EU?
I like that, more proactive approach. They feel like they're being targeted. Ultimately, they think that this is in some way anti-big US tech. It's always been felt that way when it comes to some of the fines, when it comes to the way in which they've eyed up the likes of Google, which is parent Alphabet, Meta. And this time it's sort of Sam Altman who's in the firing line. He's actually going over to speak to Madame Vestager, also Ursula von der Leyen on Thursday, to discuss the way in which you regulate OpenAI, ChatGPT, of course, which has been the viral chatbot that suddenly put, well, generative AI in the hand of the consumer, and why suddenly we're also excited and also concerned with its applications. So Sam Altman's going to take a lot of questions because remember, he himself was busy when he first saw that the EU was going to take a pretty aggressive stance, was like, all right, I won't bring my ChatGPT to your countries. And suddenly that caused an awful lot of consternation among the EU leaders. So there is this tension that continues to carry on, whether it's pushback on US leadership here, or indeed whether it's just the EU can get its act together when it comes to regulation that much faster than the United States can.
I mean, I guess it's a good thing that they're trying to, do something before it becomes a problem.
Yeah,
I mean, hey, that's different, Tom. That's different than usually how we regulate big tech.
I mean, you speak to, and he's been vocal on this, the godfather of AI, right, who was formerly at Google, suggesting that he has deep concerns about where this technology could go. So yes, the regulatory question is real, isn't it? Caroline Hyde with the update there and what's happening in terms of the tussle between the EU and the US. And of course, you can catch Caroline and Ed Ludlow on Bloomberg Technology coming up in around 90 minutes. Stay with us, more on that Jolt surprise. This is Bloomberg.
We're about an hour into U.S. trading session. Stocks trading a little heavier after that blowout JOLTS number. Abigail's tracking the moves for us. Abigail?
Yeah, indeed. And you can see that the S&P 500 E-mini futures, Alex, are at session lows right now, down about 0.8% down on the day, the first down day in 4 days. And if we take a look at other indexes, we put this into the picture, we're going to see across the board declines. The NASDAQ 100 also lower. NVIDIA having its first down day after that more than 30% move over the last 3 days, the best since 2002. China tech stocks also down about 2%. So there is a downdraft here as that JOLTS number comes out above 10 million, as Alex was talking about, suggesting that maybe the Fed is going to have to keep raising rates more than expected. But on the other hand, we have oil back below $70 a barrel at 68.51, possibly close to a break to the downside, suggesting that maybe economic activity is not so high, especially given the China manufacturing PMIs, the Chicago numbers. Let's take a look at the divergence on the year between stocks and commodities, because this could be a bearish signal. Now, this is actually over the last year, but you can see commodities down about 25%, the S&P 500 up a little bit. Typically, when commodities sell off, they lead stocks, so this is not a great sign. And finally, Tom, if we tie it all together with that JOLTS number, let's take a look at the chart here, because you can see that coming out of 2020, a massive rise higher, and now we're dipping lower, but that number up just a little bit more. I would say that overall, we probably will see these numbers start to come back in toward the 2020 levels. But again, the number a little bit blowout, like Alex was talking about, putting pressure on the markets.
Yeah, we're going to stay on that story, get more analysis now. Abigail Doolittle, thank you for the market check and the reaction to those hotter than expected numbers in terms of the JOLTS data and in terms of those job openings. Let's bring in Rubila Faruqi now, high frequency economics chief US economist. Just to start there then, Rubila, your reaction to these numbers.
Thanks for having me on the show. Yeah, I mean, the data that we're seeing on the labor market in particular and inflation, it's just showing that we're not moving in the right direction. The Fed has done a lot, and they expect a rebalancing in conditions, and we're just not seeing that. If you look at the jobless claims numbers, if you look at job openings, and if you look at the pace of, the pace at which the economy is creating jobs, it's just not, we're just not seeing the effects of 500 basis points of tightening yet. In terms of, how the Fed is going to view this, obviously the acceleration in the PCE deflator, their favorite inflation gauge, combined with what we're seeing in the labor market, if we see another blockbuster report in terms of the employment report on Friday, it just makes the Fed's job that much harder, in terms of how much further will they go, and what will be the effects on the economy.
Rubila, the quits rate, though, did fall to more than a 2-year low. Silver lining? How do you read that?
It did, but if you also look at layoffs, they also declined, right? So, I mean, there is a slight adjustment in the labor market in terms of we have come off the peaks, but we're very far from where we need to be, no matter what metric you look at. So I do think that this just is showing that the response on inflation, the response in the labor market, it has been very gradual and very slow, and it just raises the odds that maybe, the Fed has more to do, to slow and rebalance the labor market and to lower inflation.
Rubila, is this just a reminder that maybe the Fed needs to start thinking that this is a labour market with such strength, such resilience, that the trends have changed post-COVID, whether it's around the energy transition, whether it's around household balance sheets, that means that this is a labour market in the US that's just not as sensitive to rate rises as historically it has been?
Right, and if you look at what we are looking at in terms of inflation, that super core figure, that is not, especially responsive to rate increases. So that is where we're seeing the demand. But, this is the Fed's only tool, and this is the only way that they can, try to slow economic activity. We do think that this economy is not completely immune to rate hikes, and we do expect to see a response. It's just that the dynamics in the labor market have shifted so substantially since the pandemic, in terms of the supply side issues that are continuing. It's just that, rebalancing that demand and supply has been a substantial challenge.
And Tom, we could have gotten some help here, maybe from the debt ceiling deal, but from what the CBO is scoring, it doesn't necessarily look like it's going to be enough subtracted from GDP to really hit employment, or not. I don't know. We have spending cuts for the next 2 years. Will that help to do the Fed's job for it?
I mean, you touched on the fact that it's slightly perverse, isn't it, to be talking about the need to see more people out of work, to be in a place where we're slightly more comfortable, and you rightly kind of nodded to that. But again, the dynamics here, and it's not unique to the US, of course, here in the UK, and I know you have this theme around the UK sucking, but the UK also has a very tight labour market, despite it sucking to the extent that it does. So this is a challenge not unique to the US. Rabila, is June baked in then for the Fed? Do we need to start thinking about 6% from this Federal Reserve?
That's a very difficult question to answer. Like I said, if we have another inflation report coming out, we have another employment report on Friday. The data right now are not moving in the right direction, so I would say yes, the FOMC could easily lean towards another 25 basis point rate hike in June. That is not our base case. We still think that there is further tightening in credit conditions that's in the pipeline. There's still the effects of 500 basis points of tightening, which means that the Fed can actually take a step back. But I think managing that message in terms of what the market expectations are and what Fed officials might actually do, that's going to be difficult. But I do think that the odds increase if we do see another solid gain in payrolls, average hourly earnings not really moving very much, and the CPI data. We don't really expect to see much of an improvement in the core index, and that is what we're really focusing on. But I do think there is room here for them to take a breath, but the data are certainly not moving in the right direction right now.
Okay, to be fair, I don't think that the UK sucks. To be fair, what happens is every time Tom's on the show, there's like really negative UK data that comes out, and I do have in my notes today, UK sucks. Business confidence falling. So this is real stuff. Last question, Rabila. Markets pricing out cuts. Will that kind of help rather than having to hike again?
At the end of the day, the data on inflation and the labor market are going to drive the rate decisions, right? I mean, this is not about that the market should price out cuts. The pricing in cuts in the first place was very contrary to what the Fed was saying. So that has never been our base case. We actually don't even expect a recession this year. But, it's just a matter of where the inflation data go and where that labor market is heading. And like I said, not heading in the right direction. So I think that's going to drive the decisions at the end of the day. But, rate cuts getting priced out, I think that is the correct market response.
All right, Rabila, thanks a lot. We really appreciate it. Thank you. Rabila Faruqi, High Frequency Economics Chief U.S. Economist. Okay, coming up, you got rising interest rates, a slowing economy, increasing regulatory scrutiny. It is a tough time to be in investment banking. So let's talk to a man taking the helm of Lazard. Peter Orszag, incoming CEO over at Lazard, and how he's going to navigate this challenging environment coming up next. This is Bloomberg. We welcome now our TV and radio audience. Lazard announcing last week that Peter Orszag will succeed Ken Jacobs as the company's CEO on October 1st. Joining us now is Peter alongside Shonali Bassick. Let's just start with you, Shonali. Over to you.
Thank you, Alex. Peter, thank you for joining us. You know, this is your first interview since being named CEO of Lazard. You don't start till October 1st, but what are the challenges ahead of you? I mean, this deal-making slump is not, a stranger to anybody in the market right now. What do you have to work through?
Well, let me first say, I mean, we have fantastic people. We've got a great brand. We've got a lot to build on. So the market's going to go up and the market's going to go down, but the core, the foundations are really strong, and I'm really excited to help build the future with my colleagues.
What are the priorities? You talked to employees in a memo just, about a week ago here, or really just a couple of days, and you mentioned attracting talent would be part of that. The JOLTS data even just came out this morning being a lot higher than people had thought. You see this kind of across the entire market in every industry here. What is the biggest challenge for you when you're looking to talk to new people to come on board?
Well, I think we've got a fantastic platform, as I mentioned, and a lot of white space ahead on both sides of the business, both on the asset management side of the business and on the advisory side, which you're focused on. There are significant opportunities for both businesses. One of the great things on the advisory side for a moment is we are deep in both North America and Europe, and that gives us the opportunity to expand in both places that have very attractive wallets or fee pools. And then on the asset management side of the business, there are adjacencies that Evan Russo, the CEO of that business, has been looking at. So a lot of upward potential going forward, which is what makes this very exciting. We're celebrating our 175th anniversary this year, so we've got that deep history. We also have a very bright future.
For the first time in a long time, we might see restructuring start to come back in a bigger way. What do those conversations look like under the surface, especially as people are still so uncertain about what a downturn could look like?
Well, two things on restructuring. First, normally when M&A falls as much as it has over the past 2 years, you see a boom in restructuring. That hasn't yet happened. And the reason I think is twofold. One is we don't have a recession, which is what normally happens when M&A comes down this much. And secondly is the expansion of cov-lite lending over the past 5 or 6 years. More than 80% of the lending over the past 6 years has been cov-lite, which means you're not triggering the covenants as early in the process. Doesn't mean it won't happen. It just means that it's delayed. And then for Lazard, one of the things that's fantastic is we've historically been very focused on the debtor side. Our restructuring practice, which by the way is ranked #1 in the world right now, is expanding into the creditor side so that we can do both sides of the activity on both sides of that business.
Hey, Peter, it's Alex. It's so good to see you. Congratulations on the gig.
Thank you.
I hear you on this is how we're setting up. There's going to be a downturn, but the cov-lite kind of pushes it out. Do you guys have an idea of when stuff will turn?
I don't think anyone has a great sense of that. What I'd say if you're asking about the M&A market is there are some key underlying drivers that are very positive for the market, and then there's some headwinds, one of which is being taken off the table as we speak. So the key underlying drivers are things like technology, the energy transition, the life sciences revolution, and so on. Those are all very positive for M&A activity. On the downside, or the headwinds, are market volatility and the interest rate trajectory, along with the debt limit, which maybe we'll turn to it in a minute because it's being taken off the table, and then the regulatory environment. The good news is the underlying drivers are durable. Most of the headwinds are ephemeral, and so I think if you look out over the medium to long term, the prospects for a significant amount of ongoing M&A activity over the long term are very, very positive.
Peter, that's the long-term view. In terms of time frame, I just want to push you a little bit. Tom here in London, and thank you for joining us. In terms of by the end of this year, there's a debate, obviously, in terms of when the deal-making comes back, when that M&A comes back. Do you see that activity picking back up for you and the business by the end of this year?
Well, we'll have more to say about that when we report our second quarter earnings. So I'm going to just hold off on answering that question. What I would say is we are very well prepared and we are very well positioned for whatever market conditions come our way.
speaking of market conditions, like you'd look at just the news yesterday, Goldman cutting a couple hundred more jobs. Morgan Stanley has been on its second round of job cuts, really. Lazard made a decisive decision here to cut 10% of its workforce. How does this affect jobs across the financial industry? And honestly, Peter, you were the banker, frankly, to First Republic as it was figuring out its fate. Is there more pain to be had across the financial industry as we look through the year?
Well, look, I think there's a lot of stress on the regional banking system in particular, and then also, as we've discussed before, M&A volumes are down 60% over the past 2 years, especially because many firms, including Lazard, did less headcount adjustments throughout COVID for understandable reasons. That's exactly what one would hope companies would do, which would be a bit more protective in the middle of a pandemic. The combination of that and a substantial decline in M&A volume in the market as a whole is leading to the kinds of headlines that you were just referencing.
Hey, Peter, you mentioned the debt ceiling a couple times. What we're all looking for here in the market now is the liquidity suck after it. When the Treasury comes out, issues a bunch of T-bills, and the money comes out of somewhere to go buy it. Does it come out of the bank deposits, or does it come out of the repo market? How do you see that evolving?
Well, there are a couple things to say about this. First, I don't think it's clear yet that the amount of new debt issuance that Treasury has to do is going to cause, outright massive problems that some people are suggesting. It might. We're sort of at the cusp of where an issue might occur. I'd say something in the range of issuance of $200 billion a month or so might be around the kind of red line where you start to run into significant problems. And we're right at that, around that level in terms of the expectations of what Treasury has to do. But I don't want to over-index yet on the issues. However, this is one of, coming back to the regional banks, one of the factors that could put additional pressure on regional banks in addition to deposit flow going to the GSIBs, the large banks. To the extent that the just quantum of debt that the Treasury Department post the debt limit resolution needs to issue causes upward pressure on rates. That means that the alternatives to deposit holding for bank deposits become more attractive, and you should expect some outflow, whether it's into treasuries or into money market funds or into other things that float a bit more with the level of treasury rates than deposits do. That's one additional accentuating factor on regional and community banks.
Peter, we also have to talk about just the conversation shifting away from the market dynamic in the near term to the long-term dynamic of the U.S. issuing this much more debt into a higher interest rate environment at a time where interest costs are already soaring for the United States. You're on track for just the interest payments to be more than the defense budget pretty soon. And so, Peter, what is the long-term issue that the country is going to face as we think about the Treasury market and just the financial stability of the country?
Well, I think we've known for a long time that there is a long-term fiscal imbalance facing the United States. So far, it has not caused